Indian markets are taking a breather after hitting new highs in the month of November. The Nifty is closed in the green on only one day so far this month, and recent history shows that December has not been the best of times for the bulls, especially when the rally has been triggered by foreign inflows. Yash Upadhyaya is here to tell us why by use of some charts. Yash, why do you say this?
Morning, Neeraj. So I want to first go back to the month of September when we hit a low for the Nifty, and since then the Nifty as well as the Sensex, they've rallied more than 13% from hitting the low of September, but that has been on account of the strong foreign inflows that we've seen in those months. November was a bit of a one-off when it comes to the domestic inflows. We had seen negative outflows roughly around 7,000 crores, so that will be an interesting thing to watch out for as well when we get the AMFI mutual fund data, which comes out later in the day. But coming back to the point of the foreign inflows, which have been extremely strong in the last 2 months, we've seen flows in excess of 37,500 crores in these 2 months, which have helped push the Nifty from the lows of September of anywhere between 10,700 or 10,800, where we were, to as high as 12,100, which made it to its new all-time highs. And we've seen that on the back of strong foreign inflows coming into the Indian market. But moving on from there, what we've seen is that while the Nifty has made newer highs, look at the percentage of stocks that are that have moved up above their long-term moving average. So for the purpose of simplicity, we are looking at the 200-day moving average, and we saw that big rise come in after Finance Minister Nirmala Sitharaman announced the tax rate, corporate tax rate cut, and we saw the jump from almost the levels of 10,800 to as high as 11,000. But even after giving up 50% of those gains, we again saw that big pullback rally, and then we saw the stocks move up. But what we also saw is the fact that while there were more number of stocks which participated in that rally, from roughly around 30 or 35% of the Nifty 50 stocks which were above their 200 DMA, that mark shot up to as high as 60. But when it went from those levels to even higher to hit that all-time high mark, we saw that the number of members hitting or crossing above that long-term average fall. So now that is another indication that the rally in the markets has been extremely narrow. We've only seen mostly your index heavyweights like the Nifty as well, like Reliance and your HDFC Twins, your Bajaj Finance, Finservs, they do extremely well, which has helped push the markets higher. Another way of interpreting this, also strictly speaking in terms of technical analysis, is that the bulls may be losing some amount of their grip, is why we've seen last week being extremely negative for the markets, and we saw that big close on a weekly basis. Another way to look at this is from the financial standpoint. We've had multiple experts come and talk about how the markets are likely to be boring over the next 1 or 2 periods, and financials is where they are extremely positive. But we saw for the first time in almost 8 weeks, so nearly in 2 months, we've seen financials post a negative close on a weekly basis. Now, historically, whenever that has happened, we've seen a recovery nevertheless, but that was a big drop of almost close to around 2% on the Nifty Bank Index. Again, it is down to the big falls that we've seen for some of the index heavyweights like HDFC, as well as the other names like Kotak, like IndusInd Bank, SBI as well, which was down almost 4% in yesterday's day of trade. So even if we move higher, then the rally would be extremely narrow, and one aspect where we could see some amount of recovery after this big fall could be financials, because we've seen the weakness come in over the last few trading sessions. Moving forward, when it comes to the month of December specifically, just look at how the volumes have panned out. Now, this is over the last 5-year period, and on a monthly basis, only once in the last 5-year period has the December volumes crossed above their average. So December has been an extremely thinly traded month for the benchmark indices, the only exception being the December of last year. But take a look at the other 4 boxes, and you will see that each time the ones that are marked in red being the month of December, they have been extremely thinly traded. So December is the month generally where we also see most of these foreign investors, they go on their Christmas vacation. So there is that amount of foreign participation which goes out of the Indian markets. And historically, if you look at the seasonality chart as well of the Nifty, it has largely been a rather muted month for the index. So over the right-hand side, extreme right-hand side, is where the December performance is. The 5-year average of Nifty in the month of December is just 0.2%, and 3 out of those 5 years, we've seen the Nifty end in the red. But even the losses have been extremely muted, 0.3%, 0.5%. We saw a big gain in the month of December in 2017, which was up almost 3%. But leaving that out, again, the gains as well as the losses, they have been extremely muted, coming in at the most at around 0.5%. So December as a month has been extremely quiet for the indices. If you are an investor, even if you went to sleep at the end of November and woke up in the new year, it wouldn't have made much difference in terms of the headline number of the benchmark index. Obviously, can't say the same thing when you are a trader, obviously.